Ashley O'Connor, Head of Investment Strategy at Invesco. Welcome to the Inside Network's Income and Defensive Assets Symposium.
Thanks, James. It's a pleasure to be here.
Pleasure to have you. Ashley, what is a senior secured loan and what's the investment universe of the fund?
So, senior secured loan, we're talking about loans to corporates in the US and Europe, and as the name suggests, they are senior, meaning they are at the absolute top of the capital structure, and secured, meaning they are backed by the assets of the business. In that nature, they are at the safest part of the capital structure. In terms of the loan element, the feature there is that it's floating rate, which means that income rises when interest rates rise. In terms of the opportunity set, this is a huge market, $1.8 trillion in size, about 1,200 issuers across 20 industries. And actually, people don't appreciate this, represents 16% of the US corporate credit market. About half of these companies are private and half of them are public.
We're talking below investment grade for most of these, are we?
That is correct. However, the fact that you are senior secured provides great protections.
So what are the main benefits of senior secured loans within a balanced portfolio for somebody thinking of allocating to them?
So in terms of complementarity with your traditional bonds, there's three key features. The high level of stable monthly income, the fact that they are floating rate, which means income rises as interest rates rise, and the fact that they are at the safest part of the capital structure, as I mentioned. That is in contrast to many other forms of debt that may be low yielding, fixed rate, and potentially unsecured or subordinated.
So what are the major drivers of returns in this sector of the market?
Twofold. The primary driver is income. So through time, over the last 22 years, the average coupon is about 6% per annum, currently rising, as you'd expect. There can be short-lived capital impacts, but over time, it's definitely the income that drives the outcome. And at the end of the day, here you are buying pure corporate credit exposure, given you're investing in below investment grade credit at the senior secured part of the capital structure in a floating rate manner.
Is it a market for big players? Just how important is scale and breadth within the global credit markets?
Hugely important. So this is actually a privately traded asset class that's very relationship driven. So the importance of market presence and scale is more significant in this asset class than others. For instance, getting an early look at deals, being able to provide feedback around pricing, getting preferential allocations, being able to trade inside market averages, having relationships with the private equity sponsors that bring these deals to market. All of that is only possible with scale. In addition, you need obviously a deep, experienced credit analyst team to be able to assess the risks within these corporates.
Give me an example of a typical investment within the strategy.
So I know we all love a stock story, but I'm going to do something different here and not tell you a stock story because that's not what it's important in this asset class. In a credit asset class with asymmetric risks, diversity is important. I'll give you a sense of some of the types of credits that have issued senior secured loans in the past. We're talking about some household names, the likes of Callaway Golf, Burger King, some of the premium airlines, hotels, car rental companies, well-established businesses, global brands in nature. But what's really important is building a diversified portfolio. So in the case of our fund, we have about 500 different issuers where the top holdings are in the order of 1%. That's so important in a credit asset class to have diversity.
Ashley O'Connor, thanks very much for participating.
Thanks, James. It's been a pleasure.